next minute or so, and then we'll start the formal agenda. You should be aware the Collection Fund Network is an informal grouping of local authorities across England to discuss collection fund accounting issues, particularly in relation to business rates retention, and also just wider issues around how the whole system works. We do have around 5 speakers today from Pixel, LG Futures, from Analyse Local, and also Simon Hodgson from Rates Plus, and Mike Heiser from the LGA will be doing a presentation. So there will be an opportunity to put questions through the Q&A during individual presentations, and also to ask questions in the chat. So, please feel free to add those in as appropriate. If there's anything you want to raise or any issues of concern you have or any questions you have. And there will be a short roundup session at the end for about 10 to 15 minutes just to catch up on general issues that people wish to raise. And there will be a short break at about 11:05. So we'll, obviously, depending on timing, that's what our intention is. And please, if you have other meetings, you are free to dip in and out of the meeting, because we do recognise that it's quite a lengthy time period, sort of 2 hours, but bear with us as we work through the presentations. So I think I'll start by handing over to Adrian Jenkins from Pixel, who'll be presenting on the multiplier cap compensation consultation and other emerging issues. So I'll hand over to Adrian.
Thank you, Martin. Thanks. I'm assuming you can see the slides okay?
Yeah, and we can hear you okay. So.
That's great. Yeah, thank you. So we looked today at the business rates consultation, but as Martin said, take things more widely as well. So the kind of a better subtitle to the presentation would be, we're going from the very technical to the very political. So starting off with the consultation itself, which when the proposals within that consultation are implemented, will make the business rates system, if that seems possible, even more complicated than it is now. I almost think that the electronic mission to make the system as complicated as possible until such point it falls over, but we're certainly going to hit another level of complexity in 24-25. We'll look at the consumer price index. The September CPI was released a week or so ago. So we'll look at what that means for the business rate system and the settlement more widely. We'll take a view about what might be happening in the autumn statement on the 22nd of November next month, and what that means for the provisional settlement. If we get time, we'll dip into some of the outputs that were in the Institute for Fiscal Studies green budget earlier this month, which gives us some pointers really for the longer term future. We'll look at the provisional settlement as well. We know an awful lot about what's going to be in that settlement now. The social care grants were confirmed, at least in terms of their total quantum, for 24-25. So we'll look at what bits we do know and what bits we're still waiting to find out, and when we might find those things out. And then finally, the political bit, looking at what local government funding might look like after the general election. We've had the local, the National Party conferences this month, which has given us a little bit of a window into what we think they may be thinking about. There's a lot of similarity, but there are some important differences as well, which are worth exploring. So the consultation, which was issued, I think it was probably the beginning of this month, that's the link to it if you want to have a look at it. At Pixel, we issued our briefing note on the 5th of October, which is available for subscribers on our website. And the changes that are proposed in that consultation paper are really those that are required to allow the non-domestic rating bill to be implemented, and really it's picking up the consequences of that bill and the impact that it's likely to have on the business rate retention system. So it's worth having a look at the bill, but particularly have a look at the consultation paper itself. Now, the main things within that, and certainly for us, the main thing is, and there are other things in the bill that we aren't going to cover here, but the main thing for us is the impact that the bill will have on the business rate multipliers. The main thing really is that it allows for the decoupling of the small and standard business rating multipliers. Currently, the two things are uplifted, are indexed by the same factor, by CPI or RPI, and the difference between the two multipliers currently is 1.3 pence. So the standard multiplier for larger businesses is 1.3 pence higher. So it will allow ministers to decouple those two multipliers and increase them in different ways. Over the longer term, I think that will give more flexibility to ministers about how they set the multipliers. And not something I've looked at particularly, but people say that it will give them more flexibility about setting the multiplier for different sectors or for different geographies, which I guess gives them the opportunity to look at things like, supporting the high street or supporting bricks and mortar suppliers, etc. But that's for another day. I think in the short term, what we're more likely to see is ministers trying to possibly freeze the small business rating multiplier and index the standard multiplier. I don't know about that, whether that's necessarily the case, but that would be my guess, that they're looking to try and protect smaller businesses and to generate as much revenue as possible within the terms of their legal responsibilities from larger businesses. The bill also formally replaces the link between the multiplier and the retail price index and replaces that with the consumer price index. Of course, we've had that in practice for quite a number of years already, so that's nothing new. It's just formally doing that in legislation. And there's some immediate things that come to mind about, what's the impact of these changes on the business rate systems? Can your revenue systems cope with these changes? There'll be new reporting requirements. There'll be new billing requirements as well. What's the impact on business rate income? Clearly, if you've got a higher proportion of your business rates coming from the standard multiplier, and that's indexed, then your business rates will be growing more quickly than an authority with a smaller share of its business rate income generated by the standard multiplier. So it will change the growth rates for business rate income over the medium and longer term, if indeed ministers do decide to use their new powers and set the multipliers in different ways. And unfortunately for us, it's got a big impact on the way the business rates retention system works. It's got impacts on the indexation of the business rate baseline, the baseline funding level, and therefore for top-ups and tariffs. And it's also got implications for cap compensation. So all those really complicated things that we're already dealing with will become more complicated. And this is on a really quick timetable as well. So these changes could be implemented in time for 24-25. So subject to the passage of the bill, we'd expect to see these things actually in the system, in the settlement for 24-25. So we need to understand them really quite quickly. There were a number of questions within the consultation. Just cover them fairly quickly. The first, I thought that the questions were slightly out of order, actually. I think in our briefing note we reordered them, but I've kept them in the order that they're in the consultation paper here. The first one was whether we agree as authorities that a more sophisticated calculation will be required to ensure that future under-indexation grant compensation remains accurate. In other words, do we need to change the cap compensation system to accommodate the fact that we're now going to have two separate multipliers? And the answer to that is pretty definitely yes, it does. It does need to be changed to accommodate that, especially regardless of whether the multipliers diverge over time or not. There will be two multipliers now which could move in different ways, and the system will need to be set up to cope with those two different multipliers. Now, of course, we could say, well, let's keep it simple and let's not do that. But I just think that the impact in terms of under or over funding could be significant, and I think we have to accept that we will have to have more complexity here. And of course, that means different consequences for different authorities, because every authority's got its own share of income that's derived from each of these two multipliers. So in effect, each authority will have its own cap compensation fraction. In practice, there'll be two separate under-indexing fractions, UIFs, and they will be applied to the share of income that you've got arising from each of those business rate multipliers. But the effect is that you will have a different rate of cap compensation depending on your share of income that's derived from each of these two indicators. Today, the government has kept the system as simple as possible, and it's just had cap compensation based on the on the small multiplier. The fraction from the standard multiplier actually slightly lower. So the system has been slightly more generous to us as authorities as it needs to be. I think the estimate's about 50 million nationally. I think my estimate was slightly lower, but it's pretty much in that ballpark of about £50 million. And I think what DLUHC are saying is that they will bring forward these 2 new cap compensation fractions, these 2 new under indexing fractions in 24-25, and that will slightly reduce the amount of cap compensation that's in the system. I think ballpark figures about £50 million. So just to illustrate that in a bit more detail, the current cap compensation fraction based on the small business rate multiplier, the figure we all know, is this 85/499. So that's just over 17% compensation. The cap compensation fraction on the standard multiplier is 85/512. So that's, you see, that's the 1.3 pence higher on the standard multiplier, and that gives a slightly lower cap compensation fraction percentage of 16.6%. So in some ways, we're going to have to be looking at or trying to calculate or estimate what this cap compensation would be. Kind of use the word blended here, but it's kind of, you know, what's the average for each authority? Of course, the average for each authority depends on how much income you derive from the standard or small business rate multipliers. If we assume that you as an authority are getting 65%, then the effective blended cap compensation fraction is about 16.7%, so slightly lower than the rate that we're getting at the moment. I think roughly, if you wanted to have an estimate of what your loss would be on that basis, it's multiplying the difference between those two percentages by your baseline funding level. So broadly, the losses are going to be pro rata to your share of the national baseline funding level, national BFL. The next set of consultation questions is really about what sort of data the government needs to collect from you to be able to do these, work out, you know, what level of cap compensation you need, or what level of gain or loss you're suffering as a result of the new multipliers. You'll have seen alongside the consultation paper that there's a mock-up of a new NNDR1 for 24-25. Effectively, what it does is it's the same as the NNDR1s you've seen in the past, except that the income is split between what's derived from the small and what's derived from the standard multipliers. So it just adds a level of extra detail that you need to produce. I think it is necessary to be able to produce a more accurate picture. You need to take into account not just the impact on gross rates, but also how the reliefs and accounting adjustments are apportioned across the 2 multipliers. In reality, that information is not going to be available in time for DLUHC to put together the settlement for 24-25. You're going to be reporting 31st of January. By that time, the final settlement will be close to being put to bed. It'll be too late to take that information into account. So they're going to need to work on the basis of some kind of proxies. In practical terms, it'd be interesting to know whether you've had any feedback from your revenue suppliers about the deliverability of this. Like, can your systems be changed to accommodate the new requirements? I know in our webinar last week, one authority is saying that their revenues manager hadn't even heard about this a fortnight ago. So I think there's quite a bit of information broadcasting that's required to make sure that authorities are in the position to do this new style NNDR1. I think from a finance point of view, are you confident that you could split the accounting adjustments between the small and standard multipliers? You're going to need to split the bad debt provision and split the appeals to refunds provision as well between those 2 multipliers. So that's an extra task. It's not impossible, but it's going to take time and resource to do that. But then looking at the consultation questions around what happens to the system, really, what happens to the business rate retention system? How do you index BFL? How do you index business rate baseline? How do you index the tariffs and top-ups? If everyone's got a different increase in business rates as a result of having 2 different multipliers or share of income from 2 different multipliers, I think what DLUHC are saying is that everyone's baselines, BFL, BRB, and tariffs and top-ups will need to be indexed differently as well. And I think that makes sense. I can see the logic for that, and I can see why they want to do it. But it does make things, it's going to make things very complicated. I think that the elements I can see working, or how they would work, is how the business rate baseline would be indexed in the future. I can see the impact on business rate income and what that would do. And I think what we can conclude is that if ministers do index the standard multiplier but freeze the small multiplier, then those authorities with the higher shares of that standard multiplier income, people like Westminster, Inner London, the major cities, will generate marginally more retained growth over time. Even if the business rate baselines are indexed in the same way, that growth will be slightly higher above the baseline for those authorities. But that's just the way the system works. I think that's fair enough. The part of it that I don't really yet fully understand how they're going to implement is how they uplift the baseline funding level. I think it's starting to become fairly clear that their preferred option is to use a weighted average index for each authority to uplift the baseline funding level. And they need to do that so they can preserve the relationship between baseline funding level and business rate growth to make sure the levy and safety net calculations work properly. This is a debate we had back in 2013 when the system came in. So I think the principle still applies, and I can see why they want to uplift everyone's BFL in line with that weighted average. But the problem is the BFL also drives funding within the settlement now. It's actually a real figure in terms of what funding you're going to get. For an authority that's in a negative RSG position, their SFA equals their BFL. So we need to find out from DLUHC how they're going to incorporate those different authority baseline funding level uplifts into the settlement. I've asked Geoffrey Whitby about this a few times, and he understands the point, but I think they're still working on how that's going to be handled. And I don't think we'll find that out until we actually see the settlement itself. The other question I've asked of DLUHC is, can they share the data now that they've got, I assume from the VOA, that they would use to calculate proxy data? It would be useful to see what the range is for different authorities about who gets what from each of the indicators, at least at that gross rates level, that we could calculate from the VOA. That would be useful to have sooner rather than later, to be honest. So that's the consultation paper. Complicated for sure. I think DLUHC are trying to make sure that it works in a way that nobody is out of pocket, which is commendable, and they've got a good track record of doing that. But it is going to be really complicated. I think there are some effects that I don't think have been fully captured in that consultation paper, and which we need to find out about. So moving on to the September Consumer Price Index, which was announced earlier this month. The headline increase in CPI is 6.7%, so no change compared to the August CPI, and only marginally lower than the July 23 CPI of 6.8%. You can find out more about it using that link. Most forecasters had expected a small reduction in that September CPI to 6.6%. In reality, the raw CPI data was only marginally above that. It was rounded up to 6.7% rather than being rounded down to 6.6%. And core inflation is falling as well, from 6.2 to 6.1% in September. So things are going in the right direction. Wages though are stubbornly high, and I think there's a risk that these will feed into future price inflation. And I think for local government as well, you know, the issue here is that wages are continuing to increase at a higher level, and that will start to feed into our real level of inflation that we're experiencing within our own authorities, and risks that, you know, the public sector pay awards in future could be higher than the rate of inflation. Of course, we know the September CPI is the figure that's used to drive the multiplier, and therefore it's crucial for the 24-25 settlement itself. We don't know yet whether ministers will freeze the multiplier or how they will increase it, but once it's been decoupled. But we're assuming, certainly in our modelling, that the multiplier is frozen and that cap compensation is based on the new level of multiplier based on the September CPI. Based on our calculations, I think that the multiplier will go up by 6.62%. So that's looking at the CPI index of 123.8 in September 22 compared to 132.0 in September 23. So CPI, in terms of the way it's announced nationally, the headline figure of 6.7% is based on the unrounded index levels. So rather than the published indices, which are rounded to one decimal place. And I'm fairly sure that, certainly looking back at previous years, the indexation for the multiplier is based on the rounded index. So it gives a slightly different figure this time from the headline figure. So the cap compensation fraction, if the multipliers are not decoupled and if they are frozen, I think would be somewhere, I think it would be 123/499. but that assumes, as I say, that small and standard multipliers are increasing at the same rate. And for those who want to see those calculations and how that works through the system, they're in our MTFP model on our website. We're starting to get some confirmation now of some other elements within the settlement. We knew that obviously I think one of the really key ones is that September CPI. The other really big one is the social care grants. There was a big increase in 23-24. There's a further big increase expected in 24-25. Not quite so big, but pretty significant. And those increases largely have come about as a result of ministers deciding to delay the social care charging reforms and use the substantial amounts of money that were set aside for that to pay for day-to-day spending on social care. Nico Heslop, who's head of local government finance at DLUC, in one of his regular emails to authorities on the 19th of October, confirmed the quantum that will be available for each of these new grants, of each of these existing grants into 24-25. He said he'd had a lot of queries from authorities about what those quantums would be, so he wanted to just confirm what they are, which is very handy. I assume the questions from authorities were that, are you really sure you're going to give us all this extra money? And the answer is there is a big increase, and it's confirmed for 24-25. We checked against what's in our model, and you can see on the right hand side in that table, you can see the big increase in social care grant. The other grants reconciled to the pound, but the social care grant was slightly different in our model to the DLUC figures. So you can see the big increase there from 3.8 billion to 4.4 billion. We were short by about 80 million. And all I can assume is that difference is that they'll be rolling in a further 80 million pounds to help fund the cost of adult social care precept equalisation. So that was the same thing that happened in 2023-24. There was 160 million pounds worth of equalisation. 80 million of it was funded from a transfer into social care grant. We'd assumed that was a one-off transfer, or sorry, that was a transfer just in respect to 23-24. So we had that in the base for 24-25. But it looks like there'll be a second round of equalisation with a second round of 80 million to part fund it. So we've added that into the social care quantum. In 23-24, that 80 million pounds funding was funded from a top slice from the services grant, and I assume the same thing would happen again. And I think as well, this probably tells us a lot about what would how they will actually handle equalisation of the precept in 24-25. I assume, given that 80 million pound transfer, they will happen in exactly the same way again. So for those authorities on the call today who are very high tax base authorities, Buckinghamshire or a Surrey County Council, for instance, or a Wokingham or a Windsor and Maidenhead, I think the calculation of how equalisation will take place in 24-25 should be the same as it was in 23-24, and that's how we've got our model set up. So just pulling together some of these strands for the local government finance settlement for 24-25. In terms of timing, I think the rule of thumb now is always assume later rather than earlier. The parliamentary recess is Tuesday the 19th of December, and I wouldn't be surprised if it's either on that day or the day before, or the earliest, the back end of the week before that. The autumn statement's only on the 22nd of November, and even with a fair wind, officials need at least 2 weeks to do the settlement. But this is a much more complicated settlement than usual. Not only have they got to respond to things that are likely to be in the autumn statement, but they'll need to deal with that huge level of complexity that we've got from potentially decoupling the multipliers. So I think they'll need the full amount of time that's available. Last year, they brought in a new tradition of announcing a policy statement before the settlement. So that came out in the end only a week before, but I know officials had wanted to get it out a lot earlier than that. So maybe we'll get a policy statement in early or mid-December, just filling in a lot of the gaps, so that at least we know what the policy is in terms of what the settlement will look like, even if we don't know the numbers. So that should be handy. Although last year it set up as many, create as many red herrings as anything. It needs to be quite precise in the way that they word that policy statement. So just running through the things that we need to know about for the settlement. The multiplier increase and a decision on freezing or indexing. So we know what the increase should be, but I don't think we won't find out what the decisions about freezing or indexing or decoupling is until the autumn statement on the 22nd of November. The application of those newly decoupled multipliers within the settlement, I don't think we'll know anything more about that now until the provisional settlement itself, or possibly the policy statement. But you know, there's quite a lot of work to do with that, I think. So I think I'd expect that later rather than sooner. Council tax thresholds, again, confirmed in the provisional local government finance settlement, but really for most of us, we know what those thresholds will be. They were announced in the policy statement in December 22. I think it's only really police and fire where there's a little bit of uncertainty about what those thresholds will be. For fire, I would expect them to be exactly the same as they were in 23, 24, but I know some fire authorities are telling me that they're not really quite as certain as that. The future of New Homes bonus, again, I don't think we'll get full confirmation until the provisional settlement itself, but I've heard there's a strong chance that that's going to be continued for a further year. You know, it keeps staggering on this New Homes bonus, but I think one further year is likely for 24-25 at the very least. Social care grants, we know what the quantum is now. That was confirmed earlier this month. We have a strong hint about how equalisation will be applied, but we won't know for certain until the provisional settlement itself. Then public health grant, who knows? I said March 24, but really that could be any time between January and April next year. It's a bit of a rogue one, is that one, but it's very important for lots of upper tier authorities. So we know most of what we need to know about the settlement. There are details clear that we don't know, that we'll need to wait until either the autumn statement or the provisional settlement itself. But I think we've got a fairly good idea now about what that settlement will look like. I think we've got a little bit of time just to look a little bit at the Institute for Fiscal Studies green budget and how that fits into the autumn statement later next month. I mean, to be honest, it's not particularly good news. The economic forecasts that the IFS have used show the UK economy slipping into recession in 2024, and that persistent low growth makes it difficult for the Chancellor to stabilise debt, which is his main fiscal objective, really. The fiscal mandate requires debt to be falling by 2028-29, so by the 5th year of the fiscal forecast. And without growth, it's just difficult to do that. So I think that in political terms, that's going to make it really difficult for the Chancellor to justify tax cuts before the general election next year. But it also puts more pressure on spending decisions. It means there's very unlikely to be much room for any additional announcements of spending increases for 24-25 or 25-26. But before we actually get to the general election, this is going to be the last fiscal statement. It's likely there'll be a budget next year as well in March, and possibly an autumn statement just before the general election as well, if that's going to be in the later part of next year in the autumn. But with consumer price index, I think a lot of just looking at the headlines, it looks like CPI is very sticky. It looks like it's staying very high. It's proving difficult to come down. But actually, and actually, a lot of people are saying, well, will the Prime Minister meet his target of halving CPI inflation by the end of the year? But I think what all the forecasts are telling us is actually that the next month, the October CPI will fall substantially. There are base effects from October 22 that will fall out. That means that CPI inflation should fall to just above 4% in October 2023. But I think what commentators are now saying is, well, does that mean that price growth falls back to 2%, or does it stay more like 4% over the medium to longer term? Another point I wanted to pull out from that green budget is about the size of the public sector, and the IFS saying that it looks like the public sector spending is now going to be permanent, or is at the moment permanently higher than it was either before the pandemic or before the great financial crash in 2007-8. So all those things like dealing with the pandemic and the increased levels of debt and the higher interest rates that are now going alongside them mean that spending on the public sector will be permanently higher than it was and than we've got used to. Just to confirm what that fiscal mandate was, getting debt or stabilising debt by years 4 to 5 of the forecast period, but there's not much headroom at the moment based on current figures. But I think the reporting is that they're moving around quite a lot. A lot of it's obviously dependent on what the interest rates are. The Chancellor's talked about a repricing of long-term debt, and the debt payments are now likely to be 20 to 30 billion pounds higher than they were in the previous forecast. So that's a really big change that needs to be accommodated within the forecast numbers. I think the last slide on the Green Budget before we get onto the politics of it, which is that the final numbers really that the IFS have analysed is that they think that that nationally we can expect a 1% real terms increase in spending overall, but once you take out childcare, you take out NHS, take out schools and defence, that previously left a 1% real terms cut for unprotected services, which is most of local government. The latest figures, the deterioration in them, it looks like unprotected departments would need to shoulder cuts around 1.5% per year, so slight worsening. But the IFS think that those assumptions around protected department spending are conservative, and that these spending targets for unprotected budgets are now implausibly tight. In other words, they'd expect things to be slightly better than this. But for us in local government, that gives us a lot of uncertainty about what's going to happen, but it doesn't look positive. Our assumption in the model is that core grants will be frozen in cash terms, so SFA and the other major grants, apart from social care grants, will be frozen in cash terms, but they could easily be plus or minus 2%, depending on whether there's more funding made available to the sector or whether the Treasury decides to take council tax into account as well. So that's our kind of range of forecast for 25-26 onwards for the next spending review period. Then finally, I just wanted to pick up on some of the things that the national parties have been saying and what that might mean for local government funding over the medium term. So we know that a general election has to be held before January 25, and I think most commentators now are predicting the 31st of October 24, but obviously that can change. So we've had a good look at what the parties are saying, what they said in the party conferences, but also what they've been saying in announcements before and after that as well. And it's quite intriguing just trying to get a window into what they're actually thinking. There are quite a lot of common strands, actually. One is that both parties are talking about longer term funding settlements for local government. Obviously, that requires a multi-year spending review, which we've not really had since 2015. But both want more certainty as well. So they're both favouring an end to what they call the bidding wars. But these are the kind of things that opposition parties and governments, that matter, will say without really putting in place the machinery to make it happen. But certainly both parties are saying these are the sorts of changes they want to make to give local government more certainty and more control over their finances. Both parties are in favour of more devolution. Labour seems to prefer what they call a more sectoral or strategic approach rather than deal making, but I'm not quite sure what that means. I suspect it means that the deals will continue in the same sort of way, but both are certainly in favour of it. Possibly Labour are more in favour of what they call kind of community devolution. So it might see the reappearance of what was called double devolution, so a slightly different take on what devolution might mean. And of course, both parties will be dealing with severe financial pressures. You could argue that Labour have made more sympathetic noises about local government, but they've certainly been very quiet about any bailouts that there would be. And Rachel Reeves is very much laser focused, as they say, on fiscal discipline. So don't expect any big bailouts or any big handouts from a Labour government if they get in after the election. Labour have been a bit more bullish about business rate reform, and actually they've talked about scrapping business rates in the long term. Whether the long term is just, is a very long way away is another matter, but they're clearly not happy with how business rates works. And if they did want to get rid of business rates, that means the end of our business rate retention scheme. I think the key thing for us as local authorities is the fair funding review and the baseline reset. I think Labour will be under a lot of pressure to do both and do both relatively quickly. And I think they're in the unfortunate position that Labour councils or Labour controlled councils are more likely to gain from those changes. But even doing these changes in a way that helps in quotes, your own councils does require a lot of political capital. And will that be something that a new Labour government would want to use on local government funding reform? Possibly not. Intriguingly, Angela Rayner said that she wanted to do this and she wanted to channel resources on the basis of needs. There's lots of latitude in how you do that, but clearly even doing it with a fairly straight bat would still favour most Labour-controlled councils. But broadly, I think the conclusion I've drawn from this analysis is that there's no really big idea for local government from either party. Policy will be driven by the tight financial situation and priorities for the key services like social care. But broadly, I think local government will continue to be a relatively low priority, and anything that the government wants to do, or whichever party, they'll have to do things at a low cost or promote efficiency. So I don't really see any easy way out there of the kind of financial gloom that we've got. But I do think that if it's a Labour government after the election, there's going to be more pressure to do those big funding reforms like the Fair Funding Review and a baseline reset. Okay, Martin, well, that's me finished.
Okay, thank you very much, Adrian, for that comprehensive presentation. So I think it does highlight all the significant challenges, both macro and also more micro, in terms of the impact on the 24-25 local government finance settlements and future reforms. We'd have a couple of questions in the chat which we can pick up, and then we'll move on to the LG Futures presentation. So I think Joanne Whitings has highlighted concerns from software providers about their ability to make changes to systems in time for the 24-25 NNDR1 and possibly even not for the 24-25 NNDR3. I think the consultation paper, and I think you probably agree, Adrian, more or less implies that they're not going to introduce changes into the 24-25 NNDR1 because it would be simply impractical. So I think the pro forma they provided is purely illustrative. I mean, again, that's not been confirmed definitively. That seems to be the hint in the consultation papers. And then we move to the situation of having to work out these individual proxy calculations for each authority based on the VOA data in terms of small business standard multiplier shares. So that would presumably be your observation.
I must admit, I mean, maybe I would interpret that incorrectly, Martin. I was assuming that they do want to do the NNDR1 for 24-25. I think they recognise obviously they won't get the data in time to do anything for the financial year 24-25, but I think they want to see the data. So I think they're looking for authorities to do that and to be able to, to populate that new NNDR1. I mean, maybe that's something to double check with Jeffrey, or I don't know whether Lee or Caroline or Chris take a different view on that, but that was certainly my impression that they want it done for NNDR1 24-25.
Yeah, I think the concern then is practically our authorities going to be able to deliver that in time, and the implications that has for local authority budget setting and also for preceptors who'll need the data for their budget arrangements. So will people be able to hit the 31st January deadline? There is the option of perhaps doing a shadow return in February, March or something, which DLUTCH could have without actually having the data in, for the 1st of February. So
actually, I do remember now when Jeffrey Whitby spoke at our webinar last week, what he said was that when they actually issue the NNDR1 for 24-25, it'll have a button at the start that you'll flick one way or another to say whether you're going to fill it on the basis of a single multiplier or two multipliers separately. So they want the data, but they recognise that you may not be able to do it.
Yeah, so I think obviously seems a slightly odd situation then, because I expect most authorities will simply opt to provide the data for one multiplier because they won't be able to, and it's a lot less work as well. So it rather defeats the point. But we'll have to see. Again, obviously, perhaps Caroline and Chris and Lee, you can pick that up in your presentations in relation to that particular issue. And I think there's also a more technical point picked up in relation to the tax arrangements that that charities and certain other bodies are potentially subject to the standard multiplier, even if the rateable value for their property is below 51,000. Now, again, I'm aware there's obviously some changes to how reliefs and other arrangements work for central lists, but I wasn't sure if that was dealt with in the bill specifically to sort of formalise that, so charities are treated on the same basis as other entities in the future. But
yeah, I hadn't seen that. That's a good point to pick up there, Martin. I hadn't seen that one before.
Okay, I think that's all the questions I can see in the chat, and subject to no particular issues anyone has, we'll move on to the next presentation from LG Futures, which is looking a bit more around some of the accounting and modelling aspects of business rates retention, particularly what to do in Q3, but also just a general preparation for 23-24 outturn and also 24-25 forecasting in the context of the NNDO1, which we've just discussed. So I'll hand over to Chris and Caroline for the next presentation.
Thanks, Martin. Good morning, everybody. Thank you very much for the invitation to speak to you all today. Hopefully the slides have made their way onto the screen now. So Caroline and I are going to try and give you some sort of, I suppose, practical kind of thoughts about things to be doing in Q3. So we're going to probably structure this around the kind of three, as we see them, sort of key streams of activity. So you're thinking about the accounts, thinking about monitoring, and of course thinking about budgeting as well. As a reminder, our support for the collection fund is really kind of built around the collection fund suite. So that suite consists of three modules. Module 1, supporting authorities with the accounting. Module 2, supporting in-year monitoring. And Module 3, supporting budget setting by providing a review report on the NNDR1 forecast. So I'm going to pass over to Caroline now to talk about the accounting and into the monitoring, and then I will be back shortly.
Thanks, Chris. Hopefully you can hear me. I'll pick up on that NNDR1 point when I get to the relevant slide in a couple of minutes. So in terms of what we can do now for Q3, can't believe we're there already, thinking about what happened at the end of 22-23 close down, what can we bear in mind and work on for 23-24 close down? Funnily enough, this slide's pretty much the same as the one I delivered this time last year. We have still got the same issues we need to work on, I think, around system reports not balancing to each other or not even being aware that certain reports should. The biggest one for me is always the net rates payable, council tax payable, not reconciling between what gets put on the NNDR3 form, what goes in the collection fund, compares to what's on the system reports. We're never going to get from opening to closing balances without those correct amounts. Consistent issues around opening balances brought forward into 22-23 hadn't been adjusted for cash in transit and the like, so not on a proper accounting practice basis. So then when we're trying to reconcile at the year end, we're out by those amounts again. So we need to be aware that make sure that the numbers that go in the NNDR3 form, for example, are on a proper accounting practice basis and match up to the ledger, might need adjusting from what's initially included from the system reports. Usual issues around court costs and penalties not necessarily being accounted for strictly as they should have been, particularly around bad debt provisions not being split out. Good old cash and refunds reconciliations, always the difficult bit in terms of trying to get the accounts to balance. The reconciliations perhaps that are being done between the cash receipting system and the revenue system, but what we need for accounting is obviously between the revenue system and the ledger. And hopefully some issues that are going to disappear soon, but council tax estimated surplus and deficit issues, particularly around spreading, but hopefully we've cracked that one now and it's gone. Next slide, please, Chris. So as well as bearing those in mind, what can we do in preparation for the 23-24 accounts? Well, you might want to have a look at your coding structure. Perhaps is it as simple as it could be? These systems are complicated enough without having to move things around the accounts 3 or 4 times. Is everything going where it should first time? We can reconcile the cash payments on account that are happening during the year, making sure instalment 3 or 7, for example, hasn't gone missing and that it's gone to the right place and it's going to the right place first time. Reviewing opening balances, I appreciate that's more difficult if you haven't managed to roll your ledger forward yet, given the audit issues. But obviously, if we can agree the opening balances now, that's one thing in place going into 23-24. Monitoring of 23-24, I'm going to come back to that in a minute. Collection fund training and support. Again, I'm going to cover in a sec, but we gave quite a lot of support to authorities at the year end for 22-23. We're taking bookings already for 23-24. We're quite booked up, so if you do want help with the end of 23-24, then then do get in touch as soon as possible. And just to point out that obviously the timetable for close down does seem to be stuck at the 31st of May now. We didn't get the extension at the end of 22-23 that we might have hoped for. So the more we can do now, the better off we're going to be in terms of meeting those deadlines. Next slide, please, Chris. So in terms of collection fund training, if you are thinking about wanting to get ahead for 23-24, you do want some training, you might have new staff, for example, on collection fund training, then again, we can do that for you now. We've got a training system that's based on either whichever system you're using, Academy, Civica or Northgate. So looking at what reports we should be using, where the numbers come from, for example. So again, getting revenues and accountants into the same room at the same time, so each has an appreciation of what the other needs to be doing and should be doing, going from the theory and practice of collection fund accounting using our collection fund models. So it's sort of getting you up to speed with the models as well as actually the process of collection fund accounting. So if you're interested in that, then again, do get in touch, because we're looking to do that sooner rather than later and getting ourselves ready for 23-24. Now is the time to do that. Thank you, Chris. So monitoring wise, obviously, the more we can do now to familiarise ourselves with the process of collection fund accounting, the easier it will be at year end, especially given that obviously medium-term financial planning has never been so important given the financial situation of authorities. And obviously bearing in mind that this year's collection fund surplus deficit estimates that you will need to make in January 24, what do you think those surpluses or deficits are going to be on NNDR and council tax at the end of 23-24? Those will impact your budget for 24-25. They will be your outturn position for 24-25. And the extent to which those aren't correct will obviously impact in 25-26. So the more accurate we can get those, the better. So it's thinking about, for example, what we're retaining in terms of renewable energy in designated areas. Could be quite large amounts for some authorities. And based on where we are now, what impact is that going to have on your safety net or levy position, or perhaps pool benefit? Because remember, those will hit the general fund in 23-24. They're based on outturn, not on budget. Thinking about for those estimates as well, how are our collection rates going, especially in light of the cost of living crisis? Because they are going to impact on those estimates on the outturn position for 23-24, so will be impacting our 24-25 budgeted income. And also thinking about the impact on tax base, for example, council tax support levels, the take up of those. Are you going to be thinking about changing your schemes? And equally, we've obviously got a new provision to come up with for the 23 list. How much are you going to put into that provision at the end of 23-24? But also remember, we've still got some bits outstanding from 2010 and 2017. How are those moving and how are those going to impact on our estimates as well? Next slide, please, Chris. So obviously, authorities will have their own approaches as to how they approach monitoring throughout the year, whether they do or don't do it and how often they do it. Given the complexities, we know quite a lot of authorities are using our Module 2 monitoring models, which does provide for NNDR and NNDR 3 style form to fill it in. So again, we're getting familiar with what we'll need at the year end. So again, familiarity obviously will hopefully make things easier at year end. We've got reconciliations in there to the revenue system, so addressing that earlier issue I flagged up, being aware that what that needs to look like. And the calculations for the resource and timing impacts, which Chris is going to look at in a second. But I guess the win-win out of this is it will produce your NNDR 124-25 Part 4 declaration for you, as if by magic, everything will magically appear that you can just copy into that form when it does appear. Equally for council tax, obviously we have to produce that 15th of January 24 declaration amount. Do know of a few authorities that missed it for 15th of January 23, so hopefully using the forms will give that nudge that we do need to provide that declaration. And again, the monitoring model will do that for you. So how do you do that monitoring? So using our models or not, then obviously you'll need the revenues team information to be able to complete those entries. Those revenue system reports that you would run at year end run at a particular date, all at the same time, to be able to do position of where we are now and then forecast it forward. Finance and revenues working together to complete the provision movements. That's always how it works best at year end and hopefully during the year. Then in terms of the declaration that's produced, obviously needing to review those and get any strategic input into those before finalising that forecast and then feeding it into our medium-term financial plan for 24-25 and perhaps thinking longer to 25-26. So up to you how you use those tools or how you do it, but obviously I think it would be a good setup for year end if you are undertaking monitoring throughout the year. At that point, I shall hand over to Chris. I'll be back in a minute.
Thanks, Caroline. So the nice thing once you've done that monitoring exercise is the model gives you that resource output. So it's showing you the amounts that you're going to have relating to prior years in those future years. And it's showing you the updated position for the in years. So you can see the output there, an example of the output on the slide. So for 23-24, you've got all of the amounts that are going to hit your general fund. And then in future years, you've got the amounts that are going to come out as a result of the entries that you've made in the monitoring model. So we can see next year's surplus deficit amounts. So that's the amount that you'd expect to be distributed the following year. Plus also, once that amount gets fixed, you're going to have any amount that would come through in 25-26. One of the issues that's been really important over the last couple of years has been dealing with timing differences relating to Section 31 grants and funded reliefs. So what we've put on there is a suggested reserve movement for you that shows the amount of those timing differences and helps you to match the Section 31 grant, which you get in year, with the associated collection fund surplus or deficit, which comes out in future years. So you can see that right at the bottom, the suggested reserve movement there. However, what we find is that sometimes that reserve movement is sort of back to front. So the example that's there on the slide is a sort of well-behaved example. So this authority is getting more Section 31 grant than they thought they were going to. So the suggested approach is to put that in reserves and release it next year to match off against the deficit that's being forecast, so 3.8 million there on the slide. However, we quite often find that that's sort of back to front. So it might be that you've awarded less funded relief than you expected to. And that would mean that you'd have a Section 31 grant deficit that's going to hit you straight away in year. You're going to account for it in the year, but that will be offset in a future year by a collection fund surplus. So sometimes that reserve movement kind of comes up and it's sort of the opposite way around. So that's something to watch out for, although hopefully funded relief's causing less trouble than they have done recently. The other thing for you to fill in on that page, and a really important thing to think about, even if you're not using these models, is the revaluation. So the intention of the revaluation was that it was revenue neutral for authorities. And the way that government tried to deliver that was by adjusting top-ups and tariffs. That adjustment was estimated for 23-24. So what we're going to have to do is accrue the difference between that estimate and the final adjustment, which will be known from the provisional settlement, or from the settlement for 24-25. We'll need to accrue that amount into the 23-24 accounts. So that's something that hopefully you can get an idea of what it is now, and you can get it reflected in your monitoring so that you know it's coming, and it's not a nasty surprise at year end. And there's an example of that figure there on the slide. So for one example authority, it was only 14 grand there. So hopefully even if that didn't happen, that wouldn't be too much of a nasty surprise. But often we do see those numbers are much larger, so it's really going to be worthwhile to make sure you know what that number's looking like for your authority, and it's reflected in your forecasts. They published the methodology for that calculation at the last settlement. So you might want to calculate it yourself. Equally, if you've got our medium-term revenue resources model, then that figure is calculated in there for you. Or it might be that you received a number as part of support on the 22-23 NNDR3. Of course, what that figure itself won't tell you is how it's going to impact on your budgeting. So I've tried to sort of show some different scenarios here, but the key question will be how much things have changed between when you did your NNDR1 and what your final outturn position is. So although the idea was that that adjustment was revenue neutral, it will depend whether there's an offsetting difference in your income in year. And it will depend how much of that was reflected at the NNDR1. So it might be that the adjustment has gone down since the settlement, but your income has gone up, which would be all well and good. Obviously, you'd expect that both on a final outturn basis, the idea was that it was revenue neutral, and hopefully that's what it will have delivered. But it might be that your income was higher in the NNDR1 than was expected by that adjustment. So you actually, based on your NNDR1 and the settlement figures from last year, you ended up with more money than you thought you were going to have. And therefore, if the adjustment has taken some of that money away, but your income hasn't changed, you might have a movement. So I think the important thing to really just flag is that although the idea was that it was revenue neutral, it will depend on what your actual in-year income is as to whether that intention has been achieved and delivered. As Caroline said, the Council Tax Module 2 model provides you with a 15th of January declaration. So it's well worth using that. And obviously that format might well be helpful for you in sending that out to your preceptors. We quite often find that can be problematic for authorities. So for authorities that we help with the accounting, sometimes that was the hardest question we asked them was, what did you declare back in January? So hopefully this will help you to keep a record of that. There are two things that we can do to help you with that. Firstly, if you would like us to have a look at your estimate, we're happy to do a quick check of that model for you to see if it looks like there's anything that might be out of place in there. And in addition, if you would like to send us your declaration, then we will keep a copy on file and we'll make sure that those amounts are filled in the accounting model at the relevant time. So hopefully that will save you then having to try and find that declaration again. So do think about doing that as you get that declaration done. So moving on to budgeting, the nice thing, of course, about budgeting is that it's really an estimate. It's really a case of choosing some numbers and getting some numbers that everyone's comfortable with, and in particular, your CFO is going to have to sign them off. So for setting the budget, probably there's a little bit more flexibility than thinking about things like monitoring and the accounting, where you're actually going to have to kind of roll the reports and definitely do everything. So for budgeting, potentially it could be a simpler exercise. And in particular, I think one of the things that I'll come on to is the multiplier cap adjustment, which of course is undergoing, along with the rest of it, some changes as a result of that non-domestic rating bill and the consultation that Adrian was talking about. But the place to start in terms of budgeting is going to be with that monitoring and of course with your accounting as well. So you'll know from having closed your 22-23 accounts how different your outturn was from the estimate that you made in January 2023. So hopefully that is there already, and you'll know about that number. You'll know what that's going to be based on your accounting. Then, in terms of next year's declaration, the declaration from January 2024, you'll know hopefully from your monitoring what that's going to be. So although there's not a figure here on the slide, hopefully you'll have those figures ready. In terms of the rest of the budget, so if you've got our medium-term revenue resources model, that will give you some figures. Those figures are based on inflating the NNDR1 figures. So we tend not to do anything too sort of funky or speculative in that respect. And as it stands, in terms of the rest of the medium-term financial plan, we're showing a reset in 25-26. So that's the earliest it could currently be, but I suspect that even that is unlikely. Of course, the impact of a reset will depend on your authority, so it will depend what growth you've got or not got, and it will also depend on what you might expect to receive from a redistribution of resources on a reset. So, of course, the government originally had intended to do a fair funding review and to move those baselines around. But of course, if they do a reset, they're going to have some money and they're going to have to put it somewhere. So I think it's worth trying to think about what that might look like for your authority. because even if you've got growth to lose, you might be a winner from the redistribution. Of course, the opposite could be true as well. So it might be that you think the reset at the moment is going to be a good thing, but you haven't considered whether you would get some resources back. But more generally, and thinking about the in-year position for 24-25, I think the key things to consider are the inflation and any growth or decline. So although we will need to worry about changes to the multipliers and whether the multiplier is applied differently to smaller and larger hereditaments, actually what you should expect in funding terms is to get the 6.7%. So although the government is consulting on how those changes will be applied, the key thing is that what they've always done in the past is to make sure that you get the change, you get the CPI inflation. It might be that CPI inflation is delivered via a grant via the multiplier cap adjustment. It might be that it's delivered by increased rates retention or by bills going up by that amount. But what they've always tried to do is to give you that amount one way or another. So at this stage, I think for budgeting purposes, it doesn't really matter to you whether it comes from a grant or whether it comes from increased business rates bills. Although there will be some impacts around the edges, say things like whether that growth is subject to a levy if you're a levy authority, and also whether you manage to collect it all if the amount goes on the bills. But broadly speaking, for budgeting purposes, I think the important thing is making sure you've got that 6.7% or perhaps as Adrian said, 6.6%, depending on the rounding, but making sure you've got that amount in there. That was probably the biggest thing that we found last year, was that the government gave authorities the 10.1% CPI, and authorities had worried that they wouldn't get it, so had not factored it in. So we probably had more calls last year about people who sort of found they were getting this 10% that they weren't expecting, rather than the other way round. If you've got some information, then you might want to think about whether there's any growth or decline, whether there's anything material happening in the tax base that you should be considering. Important, if you do that, to think about any part year effects. Obviously, if your tax base grows by £1 million halfway through the year, you're only going to get half a year's income in the first year, if that's when it comes online. So it's worth thinking about that, and worth just making sure that you kind of really think through when you're expecting it to happen. The other thing raised on the slide as less important is about future surpluses and deficits. So I'm not suggesting that you don't think about the surplus or deficit that's going to be distributed in 24-25, but what I am suggesting is that should be your best estimate. So you shouldn't be saying that you're estimating, say, £1 million deficit, but that you're going to be wrong by £1 million that's going to come out the following year. Of course, the exercise that we're supposed to complete in January is putting together our best estimate of the position. So I wouldn't expect to see too much sort of thought given to how wrong you might be, because if you know how wrong you might be, then of course, in principle, you should be declaring that now. So I wouldn't expect the future surpluses and deficits to be something that you want to worry about too much. I'm going to pass back to Caroline now to talk about the NNDR1. Thanks, Caroline.
Thanks, Chris. So Adrian mentioned about the draft form. This is the screenshot from the consultation that's out there at the minute. I'm in the process of reviewing the form from DLUHC, and the version I'm looking at the moment does have this magic button that says, yes, I will be able to split my numbers between small and standard multiplier, or no, I won't, in which case you'll be filling everything in under the small multiplier. It is expected, I think, that everybody will be able to split their gross rates calculation between the two, because obviously you know what RV is above and below the threshold, therefore at least you can do that first line split between the two. It's then whether you can do the reliefs at any lower level of detail. So what I would suggest is that you do familiarise yourself with that form that they've sent out in the consultation as to whether you will or won't be able to fill that in. Obviously, we might not know until we get to closer to the time, but at least you can see what's coming. I had a fun Friday afternoon trying to unpick the Section 31 calculations in terms of they're making them more transparent, but they're making them very, very long. So they seem to be working. in terms of what's happening, but I'd say in terms of getting on the front foot, familiarise yourself with that form that's coming. Next slide, please, Chris. So parts 1 to 3 of the form may look slightly different, but part 4 looks exactly the same as to what it's always done. This is where, if you are using the monitoring models, then it will give you the numbers that drop straight out to be able to complete that part of the form. Obviously, the models will give you that the form weren't necessarily from that. Is obviously the Section 31 forecast and the Levy and Safety Net forecast for the current year. Obviously, the form will do it for the forthcoming year for the Section 31 forecast. Also, the models will give you the disregard amount forecast and your balance sheet forecast as well in terms of bad debt provision and provision for appeals. Again, like Chris said, we can have a quick look at your models for you if you want to send them through to make sure everything looks as it should, that things are reconciling back to system reports before we start to make any more further forecasts. But hopefully, by using the monitoring model, you've got assurance that you have got the right numbers going into part 4. We've often seen the wrong numbers used from the previous year's NNDR1 forms. So the more we can fill in for you, then hopefully the better that will be. And then just the last slide, please, Chris. In terms of NNDR1, we will be doing a training session for Module 2 and 3 subscribers. Booking information for that will be circulated shortly, as will the information to allow you to book for your Module 3 support. So reviewing your NNDR1 24-25 form once you've actually got it filled in. If you're signed up to Module 3, you send it in to us, and we'll look at an overview of how the changes on the form will impact your situation, analytical review of the entries before you get it signed off, benchmarking your appeals and bad debts, and obviously the impact on the medium-term resource projections. So just as last year, if you used that service, you'll need to book your slot and provide the draft form 2 working days in advance of that meeting. Let's say we will be sending out an email shortly to allow you to book those slots. So I think that's everything that we've got to say. I think Chris is going to pick up on what's coming next, but that's everything from me. So again, the usual good luck for what's coming, and we're there to help you as much as we can. Thanks,
Brilliant.
Chris.
Thanks, Caroline. So I've tried just on this last slide to summarise the activities over the next few months. So obviously we've focused on kind of things to think about in Q3. To some extent, that was things that you might have thought about already if you kind of finished all your accounting and done your reviewing of it. But hopefully that's given you a summary of kind of where you might want to be at, and things to be thinking about for the moment. Given we're a few minutes behind, I'm not going to talk very much about this slide, but obviously these will be circulated after the meeting. And please do get in touch if you'd like to discuss any of it, or you've got any questions, or if you don't have the Collection Fund Suite support at the moment, and you would like a demonstration, we're always very happy to get those booked in and show you kind of how the different modules fit together, and how they can help you. So thanks very much, and hopefully Martin's going to come back. I don't know if there's been many questions pop up.
Yeah, thanks very much, Chris and Caroline, for the presentation. So I don't see any additional questions in the chat, but we will have a sort of 10-minute catch-up session towards the end. I wasn't sure if either you or Caroline is planning to stay around for the rest of the discussion, but see if not, we can feedback after that. So I suggest we take a quick 5-minute comfort break now, and then that'll be followed by presentations by Analyse Local, Mike Heiser from the LGA and Simon Haltington from Rates Plus. So I'll see you about 11:15. Okay, thank you. Okay, thanks very much, everyone. So we'll now move on to the next presentation from Analyze Local. So I'll hand over to Luke if he's available on the call. And this should last about 20-25 minutes. And obviously we can potentially take questions as well at the end of it. Okay, over to Luke.
Thank you very much. Yeah, so as Martin said, this presentation probably won't last 25 minutes in all honesty. To be honest, from the previous presentations we've had, I feel a bit more light relief really from the sort of the complex content of those two presentations. Hopefully you can see the presentation in front of you and everyone can hear as well. So just to introduce myself, my name's Luke. I'm the client director for Analyze Local. Analyze Local is a product suite that is supplied by Inform CPI as the company. So Analyze Local, as I said, is a product suite that offers a range of different services to local authorities. The product suite was introduced back in 2013, really sort of leveraging off the amount of data that the company had put together at the time and has continued to put together over the last 28 years. The different services that we offer, we started off with RV finding and forecasting around appeals provisions, and then we subsequently added those additional services to include small business rates relief audits and business rates consultancy through our virtual rates manager service, and more in the latter, the council tax findings, so we're identifying missing council tax assessments out there. Our clients, we currently work with over 180 clients across the country. So we work with the biggest to the smallest and ultimately everyone in between. So in terms of my presentation today, just a very brief agenda, looking at sort of income maximisation and sort of where we are and how have we got to this position. The rating list as a whole, before looking at Analyze Local, how we can help, the benefits of our service and some of the results and things like that behind our approach. So I must admit, when presenting this to you guys, I do feel a little bit of a fraud coming in and sitting in front of you to try and sort of to tell you this, because you guys will you know it far better than I actually do. However, to sort of generally sort of set the scene, where have we come from? So before rates retention, we're looking at where we were, all revenue being collected was being passed to central government. And then redistributed based on sort of assessments of needs and things like that. And obviously those sorts of situations really sort of there's a lack of incentive. So there's a lack of incentive for the local authority to sort of reconcile their list, be on top of the changes in the local area. And there's sort of a lack of accountability as well. So, if there's changes to properties, and they're not reported, then ultimately what was the consequence? What was the impact as a result? Business rates retention came in as a result of in 2013 as part of the Localism Act, and that really shifted everything. So we're looking at the aim ultimately was to give councils greater control over their finances, was really there to incentivize growth in their local list, and to really improve that accountability as well, as the council was then directly responsible for raising, collecting, and then spending the revenues that they've generated. But as you will all have an opinion on, ultimately, has this been a success? So as part of the work that we carry out across the range of services that we offer, we spend a lot of time analysing the list itself and the sort of the weekly schedules that take place. So whether this is identifying trends and movements as a result of the appeals process for our forecasting services, all the way through to then looking at valuations and identifying where there's maybe gaps or anomalies as part of our RV finding and income maximisation work. The graphic in front of you is there to display the rating list as a whole over the last few years, back to 2005. So in 2013, when we first started out, the general perception was that the rating list was fairly accurate, despite the sort of the lack of incentive that previously mentioned. You know, revenues teams up and down the country had done a really sound job of maintaining the list in tandem with the valuation office. Since 2005, what we can really see is that the rating list has remained largely consistent, largely stable, with clear steps in total value as we look at each point at revaluation. The upward trend of the list has also continued, though at a much less amount than back in the 2010 revaluation. However, looking at the cumulative impact of the schedules since April 2013, there is a significant reduction in the value in the rating list. So looking at those three lists, so the 2010, 2017 and 23 list, we can see that there's an actual total reduction of 640 million RV that's been lost through that process. The table in front of you then shows those changes as a result of different case types, different alteration types that have fallen to the list. So despite the volume of reports that are sent by local authorities to the valuation office agency, the overall impact of those is much less than the impact of the alterations through the appeal system. So the table in front of us shows that BARs, so the reports that are sent from the local authority to the valuation office agency, account for 37% of all alterations that have been made to the list since April 2013. And all of that is a cumulative increase of 8.4 billion in RV. However, the losses through the appeal system, although the volume is much less than the BARs, represent a much greater impact. So it's actually a loss of 11 billion in the list. So these case types shown in this table are shown as CHK, IPP, CHG and APL. So when we look at something like this, it's really important. It really just highlights the importance that, you know, we do need to sort of counteract the impact of the appeals process through income maximisation and increased services. So it's clear that there's obviously financial challenges for local authorities. And again, I'm not going to sit here and try and explain to you guys exactly what they are. You know, you're much better placed to sort of quantify and qualify those for each of your own local authorities. One of the sort of critical parts of this is that it's really important not to forget that local authority revenues teams also face their own challenges as well in terms of, you know, as part of raising and collecting this revenue. So, you know, teams are being, you know, downsized. You know, functions such as the inspection teams are often sort of notably hit. There there's often a requirement where some of these services have to cover different multiple functions. So a business rates team might start undertaking council tax work, or contact centres are brought in. And in doing so, what we tend to see is that these teams are spread incredibly thinly, and ultimately the expertise is lost as a result of that. Councils obviously don't have easy access to resources to maximise their position as well, and also they don't have the sort of the flexibility to be able to sort of create these different software packages or sort of bespoke packages that would allow them to carry out their functions to the fullest. So Analyse Local, so our approach on where we really fit in and really how we can help. You know, before we sort of get too excited about this, you know, please don't think that we've got sort of a fleet of drones that are flying through the skies. Certainly the cost of those and the licensing and the insurances that are required would have put us out of business long ago. Also, any sort of suggestion that we're somehow part or linked with some kind of big brother, again, couldn't be further from the truth. But what we do is that we will pull together numerous data sets to validate the rating list entries and identify anomalies as a result of that. You know, we as an organisation are incredibly data driven. We use, you know, the latest technology and techniques to compare and scrutinize sort of, you know, aerial photography and planning data. We see different contrasting data as well that comes in, that we're able to really identify things that have been missed either by the local authority or the valuation office agency as part of maintaining the rating list. But one of the critical parts of this, and it's critical to the whole operation, is the large dedicated team that we have in place in the background. These people, these analysts, link all this data together. So what we're able to do is to apply that human approach to data matching, where we can really sort of get rid of red herrings, false positives along the way. The last thing we want to be doing is wasting your revenues team's time and then the valuation office agency's time as well. So we need to be 100% certain that the cases we're sending over are valid cases. We can only do that with this team behind us. If it was reliant on data matching, then unfortunately the results wouldn't be so positive. The large dedicated team is also there to act as an extension on your revenues teams as well. So we're really able to sort of start to provide greater assistance and support to your revenues teams. So what do our results look like? So what have we done for our local authorities since 2013? To date, we've identified over 430 million in additional rateable value that we've added to the 2010, 17 and 23 lists. Based on this, and especially considering the backdating elements within each list, this additional rateable value is generated just over 1.2 billion in additional rates. But most importantly, it's created £534 million worth of retained income for our local authorities before we start looking at reliefs and other reductions. As I said at the start, you know, we work with 180 local authorities across the country. And in each one of those regions around the country, we have added value to the rating list. So from the smallest up in the northeast, where we've identified 1.6% of our 430 million in that region, all the way round to 18% in the southeast and 25% for our London clients. But there's certainly been no local authority across the country that we've worked with where we've not been able to identify a decent volume and caseload of additional rateable value that has been missed. So a few examples of what's missing really. As part of our work, we will look to identify absolutely everything we can do. So we will look at things that are from the smallest in rateable values. So we've got some examples of ATMs and Amazon lockers and telephone masts, all of which I don't believe we can actually refer in the list anymore. But the small items all the way up to some of the biggest. So we're looking at complete office blocks that have been missed, big warehouses that have been missed. And on the right there, some sewage treatment works, which had about a third of the value missing from the list. So it's completely understandable that these things do fall off the radar and that are missed. And as part of our work, we're able to sort of act as a safety net to catch those as they do slip through. We continue to add to the rating list as well. As it stands at the moment, our current caseload that's outstanding with the Valuation Office Agency is we'll look to bring in about 20 million worth of retained income for our clients up and down the country. It's a really critical time at the moment in terms of income maximisation. Through our liaison with the Valuation Office Agency, we are in a push to get as many cases in before the backdating to the 17 list is closed. So everything has to be brought into the list by the 31st of March 2024, which then ultimately we need to give the Valuation Office Agency as much time as possible to bring that in. So we're really looking at advising our clients that we need to increase this caseload and get these reports in certainly by Christmas, but we're really targeting the end of November based on our understanding the workload of the Valuation Office and how quickly they get through these cases. All of our caseload though is provided with as much information as we can do. So we extract all of this data out of all of our systems and we provide reports to our local authority clients that gives this information. It gives every bit of data that is required to reflect this in the late rating list. And as a result, we can really see some of the the improvement in the reduced time to actually from referral to the Valuation Office and getting this into the list. So we're confident that we can certainly add a fair bit of value before the 2017 list completely closes off. So just very much in conclusion of really the work that we do, working with suppliers around income maximisation, such as ourselves, such as Analyse Local, there are obviously clear benefits in what we can support and assist your revenues team. As I said, it's working as an extension to those teams, not replacing them. Suppliers will be flexible in their approach, and have access to these additional resources that the council can start to leverage on that they've not been able to do so before. The amount of data out there is absolutely incredible. And working with suppliers such as ourselves gives the council access to that data and access to resources that they've never seen before and they've never had before. And finally, we're here to sort of minimise the risk. The Analyse Local offering, the solution that we provide, is completely success based. So we, as a council, you'll only sort of pay for services at the point in when you actually get the benefit from the caseload that comes in. And as I said, that's my presentation.
Okay, thank you very much, Luke, for that comprehensive presentation. I think it just does highlight the importance of the work that Luke and his colleagues and obviously other providers have been undertaking just in terms of income maximisation, ensuring the list is accurate. And I think it does highlight the importance of the upcoming deadline for the closure of the 2017 list, which, while the technical deadline is the 31st of March, authorities do need to work with their contractors as well to actually submit those BARs, etc., as soon as possible. I think, you know, the VOA indicated potentially, you know, end of December, possibly the end of January as sort of being a very much an endpoint, but there's just a risk that if you don't take that forward, there's a possibility you could lose out on significant sums of income moving forward, because clearly all that data could be backdated several years in some cases and would also migrate to the new rating list. I don't think there's any questions that anyone has raised specifically on that. So obviously, Lou, you're welcome to hang around for the sort of last 10 minutes where we'll have a more general catch up at about 10 to 12. So just wondering, checking if Mike Heiser is on the call. So we'll just have a short 5 to 10 minute presentation from Mike on current developments from the LGA's perspective, just drawing on some of the presentations and issues that have been covered in the earlier presentations. So I'll just hand over to Mike.
Okay, thank you very much. And thank you, Martin. I don't have any slides, but I will put a link in the chat to the first thing that I'm going to refer to, which is the LGA's autumn statement submission. It's in the form of a letter. It's been sent to the Chancellor and it's been published, so that's the link on our website. It points to current pressures, particularly in children's services, adult social care, housing and homelessness, and net zero, and they're all detailed in the submission. If you'd asked me this time last year, I think I would have said that the government is aiming for a 2-year funding settlement, as Adrian said, and that it's unlikely that there would be more money for 24-25. I think with the sort of evidence that we're providing, there's absolutely no guarantee that, if you like, the sector's making a submission, so we shall have to see what happens in the autumn statement and the settlement. So coming to something that Adrian touched on, the NNDR bill is no longer a bill, it is now an act. It got royal assent last week. The multiplier cap compensation, it closes on the 2nd of November, so you've got a couple of days to get your responses in. The LGA response hasn't quite been signed off by members yet, but what we're encouraging them to say is that we're calling for ministers not to use the powers that they've got in the Act. As Adrian says, the Act gives them the powers to set 2 multipliers. It doesn't force them to set the 2 multipliers apart. So they could, if they wanted to, keep the gap between the multipliers at the current 1.3 pence in the pound. I put that actually in a meeting to DLUC a few months ago, and they said, well, yes, of course they could. It's powers, and it's powers they're not being forced to, but they sort of gave it to us to understand that it wasn't their call, but sort of they were being pressed to do this by the Treasury. So let's see what happens. As Adrian and others have said, there are severe questions on whether it can be delivered for 24-25. I think once DLUC had finally started engaging the software suppliers, they realised that it was a bigger thing than they first thought it was. Certainly, in terms of revenue managers, my understanding is that the software suppliers are very much aware of it, and it's a headache for them. So hopefully, revenue managers will hear about it through that, if not through anything else. While we're on the settlement, as Adrian said, I would expect a late settlement. I won't repeat any of the things that Adrian said, other than to say that one thing that happened in the final settlement last year was that £100 million worth of resources from the business rates levy and safety net account, formerly called the levy account, was distributed. Now, that was published for 22-23, and it suggests that there's leeway to make a similar or even greater distribution. Again, I asked DLUC about it, and they said, well, that's a matter for ministers and that's a matter for the settlement. So, but don't be 100% surprised if that happens, if in the provisional or in the final settlement. I think it's one of those things that they like to sort of, keep up their sleeve and roll out at the time of the final settlement. Another thing, there was a, coming to council tax, there was a consultation on aggregation of HMOs, very much sort of pressed by one or two MPs. We said in our response that there would be an impact for council funding of aggregation, and that they should quantify this. We also asked the VOA just what the implication was, and the VOA told us they didn't know. If you look at the response that was published on Friday, the VOA have said that they think it's marginal. What they are going to do is use existing records and on licensed HMOs to go ahead and aggregate them in short order, and then rely on applications to the VOA for unlicensed HMOs. Now, we're trying to get a handle on exactly what the implication for councils will be. We will ask DLUC about this, not least at a partnership forum meeting, which is coming up tomorrow, and at least potentially there could be an impact on the new homes bonus, which, as Adrian says, the sector is expecting. Nobody's actually confirmed that there will be one further year of new homes bonus, although of course it will be just for 1 year and there won't be any legacy. I think those are the main things I want to highlight. Happy to answer any questions. Oh, sorry, there's one more thing. We have sent out a LGA survey on finance workforce planning to CFOs. We haven't had a wonderful reply so far. I mean, it's something that the sector has been encouraging us to do, particularly given the shortages in finance departments that you will be aware of. We would encourage more CFOs to fill it in. So if you are aware that it's sort of kicking around your department, it would be appreciated if you gave a nudge. That's me. Thank you.
Okay, Mike, thanks very much for your presentation. Any questions anyone has, you're welcome to post them in the chat. Obviously, it picks up a number of issues. Clearly, we've got the impending autumn statement, and I think it also highlights around the distribution of the levy account surplus, that there are also some prior year issues because the current calculations need to be updated for revised 21-22 accounts. So I know in case of my authority, we're due a refund from DLUTCH on our levy account because a couple of authorities have changed their NNDR3 returns. So that'll obviously have to work through as well in terms of the calculation of the levy account surplus and distribution of that. But we would expect and hope to see some of that distributed. And obviously, thanks for picking up some of the other wider issues around the uncertainty moving forward for 24-25, particularly as we head into a general election as well. And obviously interesting as well to note your point about delaying, at least for 12 months, any changes to the multiplier uplifts and the decoupling of the two multipliers. So it'll be interesting to see what's announced in the autumn statement on that. So on that basis, I'll just hand over to our next speaker, Simon Horsington from Rates Plus, who's going to make a short presentation, just sort of covering a few issues from his perspective, which sort of aligns to some of the issues as well that would have been picked up in the Analysed Local presentation a bit earlier. So I'll hand over to Simon, and then we'll be back for our general Q&A in about 5 minutes or so.
So hopefully you can now see slides with a bit of luck. Hello? Ah.
Yep, we can see it.
Oh, fantastic. So good morning, everybody. Simon Horsington, Rates Plus Rating. Very broadly, as Martin's briefly alluded, we're in the same space as Analysed Local. You're not going to get 20 minutes off of me because obviously schedule's very tight this morning. So trying not to overlap with what's already been said, the summary of what we can do from the point of view of what billing authorities are normally given a somewhat more difficult challenge. Tax-based building for us, I think there's merit in targeting larger ratepayers and premises with the footprint to withstand changes in their rate liabilities. We think that's quite important, but obviously if you focus on the bigger taxpayers, they've usually got agents that are very well able to defend their case. That sometimes means dealing with specialist or high value premises. We've had experience of that both with defending the central list in London and with things like Vodafone fibre optic networks. Completion notices are usually very difficult for the billing authority, as are defending cases at the valuation tribunal and sometimes magistrates court. And of course, as our earlier financial speakers touched on, the whole issue of losses on appeal and charges to the provision can often be more difficult for revenues-based colleagues. So just moving on to some specific examples of some of the stuff that we've been able to successfully locate. You'll see from some of the pictures we've got some of our client base, in fact all of our client base is heavily skewed towards London and the Thames Valley. So here's a prosperous office block in the Thames Valley, which you can see is clearly present. It had been on site since about 2012 when it was mothballed, and it managed to stay out of the rating lists until about 2017. The total footprint at this site was a rateable value of about 2 million quid. I should hasten to add that we did not charge it on a contingent fee because obviously that would have given a completely unrealistic fee liability to the council at hand. So I mean, just illustrating the fact that there are sometimes very big units that are just sitting there not rated. So and then the final one, which I've got, we didn't win this one, I should say, but obviously this one's at 1 Canada Square in Canary Wharf. Got my little red box on the bottom picture, which shows you the floors which were and indeed remain absent from the rating list. Fundamental to the ratepayers' claim here was that the property was actually a plant room for the 3 stories of retail shopping that are actually below this building on the lower parts of Canary Wharf. If it's a plant room, I'm a Dutchman's uncle, but anyway, we weren't able to get this one across the line very simply because the billing authority and its agents have no right of inspection. So notwithstanding a very strong rebuttal from the ratepayer agents, which was saving and continues in perpetuity to save their clients, the Canary Wharf Group, from something like a £5 million RV payment liability. If we can't get inside the building to take counterbalancing evidence, our ability to withstand such claims is unfortunately limited. That's the sort of thing you're up against when you're dealing with the bigger ratepayers. Nothing illegal, I should hasten to add, on what they're doing. It's legitimate management and minimisation of tax liabilities within the construct of the rating system. That's me. Thank you very much for listening, and hopefully that made sense. Any questions, of course, be pleased to assist.
Okay, thanks very much, Simon. So we can move on to our general catch-up, just picking up on the items that we've discussed previously. Clearly, presentations, including the last one, will be shared with those who have attended in the wider distribution list over the next day or so, obviously subject to double checking with all the attendees that are happy to do so. So again, I'm not seeing anything specific in the Q&A, but I think we can perhaps just have a general roundup on some of the key issues and concerns. I mean, clearly, see, the key next stage in the whole process will be the autumn statement on the 22nd of November, where we would expect some sort of clarity from ministers around their proposals around the NNDR multipliers for 24-25 and whether they do look to dislocate or the two and potentially have a larger uplift for the standard multiplier and potentially freeze the small business multiplier. So we'll have to see how that transpires, and that will presumably clearly cover any proposals around business rates reliefs, including any changes if they're planning them to the retail leisure hospitality relief, and then we'll move on to the provisional settlements and possibly the policy statement shortly before, in assuming mid-December, but it's quite possible it could run into the week just before Christmas, given I think Parliament doesn't rise till the 19th or 20th of December, so it's possible it could be quite late in the process. So we are intending to have a further collection fund network probably sometime in mid-January, between the publication of the provisional settlement and the submission of the NNDR1 returns at the end of January. So we will provide further update on timings for that in due course, and you'll obviously have a wide range of speakers as well to that. Obviously, we'll just make sure we align with any other conferences and events and webinars that other entities are holding. So again, subject to there being no further questions raised in the Q&A, unless Jamie, you're aware of any that you're seeing privately, because I'm not seeing them in the public chat. There's probably not really much more to add at this stage, but to say thank you very much. Sorry,
Martin, we do have a couple of questions that are coming through on the Q&A tab. So if you look at the top and then just click on Q&A.
Yeah, because unfortunately I'm seeing Jamie close this conversation an hour ago. I think, a couple have just added now. Yeah. So I think Lindsay's highlighted around question 4 and 5 of the consultation document in relation to the proxy mechanism, and clearly there's a potential for them to determine a proxy for 24-25 budgeting, assuming the NNDR1 returns aren't going to be all completed in the new process by individual billing authorities, and then have a reconciliation arrangement in the 24-25 outturn. Or obviously there's the option they could, in theory, continue with the proxy arrangement indefinitely, but I think they're looking to get more accurate data. But I wasn't sure if there's anything, if Adrian or Caroline or Chris are on the call, they wanted to add around question 4 and 5, because I think probably a lot of people are slightly struggling to cope with these sort of, as Adrian's highlighted, the format and order of the consultation questions in terms of responding to them. But anything, Adrian or Chris or Caroline want to add on that?
All I was going to say, Martin, on questions 4 and 5 for Lindsay's question, I don't think we'll have much choice. I think in the end, will be running on a proxy. And actually looking at Joanne Whiting's question, comment below that about Capita saying that they won't be able to make system changes in time for NNDR1 and possibly not NNDR3. I think we'll be running with proxies for quite a while, just because the data just won't be there. It may be there for some authorities, but it doesn't look like we're going to have a consistent, comprehensive data set across the sector. One thing I did ask Geoffrey Whitby at our webinar last week was whether they could, if they did run with a proxy to start off with for 24-25, you know, can they actually start checking that against real life figures to see how accurate it is? He kind of said that they would be wanting to do that anyway, but whether that means that they're going to check it and just do nothing, or whether that means they're going to check it and revise, I'm not sure. I think they're not going to go back and revise 24-25 based on revise the proxies. If they use proxies, they're not going to go back and revise them based on actual data for 24-25. I think it would just be if things are very different from between the proxy and the actual data, they may need to revise things for future years, but even that I'm not sure about. So to go directly back to Lindsay's question, I just don't know whether the proxy is better or not. But I think it's probably better if we have the option for it to be revised and tested against real data.
Yeah, thanks, Adrian, on that point. And I think obviously as the consultation paper does highlight, they have, you know, effectively publicised the local data for Cornwall and the City of Westminster. So if it's available for those two, I'm not quite sure why they couldn't have published alongside the consultation the same percentages for every single building authority in the country, so they could have tested them as part of that consultation. It does seem slightly odd to pick 2 authorities and a couple of regions, but not the rest of the country. But that's perhaps something you and others continue to follow up on, because clearly we are going to get them in some form, we assume, alongside the settlement or at some stage before the final settlement, so that, you know, the NNDR1 returns and can be prepared and calculations can be undertaken by individual authorities. So it'd be interesting to see how that develops. I wasn't sure if there was anything Chris or Caroline wanted to add around that as well. I think Adrian's covered it pretty well anyway.
I think he has, but I suppose I just wanted to kind of mention that your system may not provide kind of helpful reporting about it, but it should be possible in some format to get some information out which you could use to calculate it if you really want to. And it will depend on the system as to how easy or difficult that is. So from Civica, for example, you can get a line-by-line breakdown of the financial control report, which effectively gives you a summary of each bill that you could use to get to a kind of detailed position. And I suppose, you know, one of the issues about this question of what they use to proxy it, obviously you'll only be able to know whether it's any good for you if you've actually got the precise figures, I suppose. So I guess the kind of incentive for, you know, the incentive for maybe doing quite a lot of legwork to get to a point where you've got some precise figures is that you might know one way or the other. And I suppose that's also the case for things like the NNDR1. So if we do end up with a different multiplier cap applied to different sets of figures, then that will have an impact on your on-account payments. So if you're getting more multiplier cap grant for small businesses and everything goes in the small business column, you know, it kind of will, I suppose, it not doing that work earlier might store up problems for you for later. But it is just a really difficult area.
Okay, thanks, Chris, for that. I think there are a couple of other questions around the London business rates pool and 2021 reconciliations, which I think Chris has answered. I mean, clearly there are a couple of billing authorities in London. I'm sure that's the case across the country for areas with pools that still got to sign off their 18, 19 and 19, 20 accounts, but it's likely that will only have a major distribution for that individual authority and possibly their major preceptor, but we will keep people updated on the implications for London business rates pool if those authorities or any of the others that haven't concluded 2021 do make material changes to their calculations. But I think, see the point that's been picked up around interest on refunds. I think, as Chris has highlighted, that's the general fund charge. So, you know, it would be shared through, you know, a collection fund charge, I should say. So it would be shared, you know, through the collection of unbalances with preceptors and central government in respect to business rates. I think that's all the questions that have been asked in the chat. So obviously, you know, good luck with submitting your consultation responses by this Thursday. It is quite a complicated set of proposals to get to grips with. So hopefully DLUHC should be able to find a suitable solution to that. And as I've indicated, we are intending to hold a further meeting of the Collection Fund Network in mid-January, just to pick up some of the issues rising from the settlement and presumably the government's response to the consultation and wider issues around local government funding. So I'd just like to thank all the speakers today from LG Futures, Pixel, Analyze Local, Simon Horsington and Mike Heiser as well. And we will, as I've indicated, be circulating around their presentations. And just thank you again all for attending, and, you know, have an enjoyable afternoon. Hope you won't be spending too much of it writing your consultation response for Thursday. Okay, thank you again and goodbye.
Thank you. All right.
Thanks, Martin.